Welcome to The Missing Link, a podcast where crypto and insurance come together. I'm Dan Roberts, and my co-host is Danielle Wall-Elliott. Whether you're in crypto, traditional finance, or in need of a new podcast, The Missing Link will help you explore the vital role that insurance plays in crypto and how blockchain will disrupt insurance. Join us on our journey to find the missing link.
The Missing Link is brought to you by Names. Names is an on-chain insurance marketplace where you can access exclusive opportunities for yield on your crypto with diversified portfolios of risk through insurance as an asset class. Names is revolutionizing the insurance sector and bringing the marketplace into the 21st century through tokenization, innovation, and transparency.
Hello, everyone. Today we are joined by Martin Carrica, the co-founder of Mountain Protocol. Mountain Protocol are the issuer of USDM, the first regulated permissionless yield-bearing stablecoin, licensed by the Bermuda Monetary Authority. So we're great to have another Bermuda-regulated entity with us. He takes us through the stablecoin landscape, talks about how he's getting his whole family onto stablecoins, hopefully more USDM than others. We really love this conversation, particularly if you want to earn yield on your capital, and what that means for not just institutional investors, but for retail investors, then this episode is for you. Enjoy.
Hi, Martin. How are you today? Thanks for joining us.
Hey, thank you for having me. Pleasure to be here.
It's so good to see you. One thing I wanted to even supersede our lightning round this time was I wanted to dig in a bit more to your background. I find it really compelling. I feel like you had a specific need for stable coins and then, even for a yield bearing stable coin. And so, I wanted to see, you've lived through bank runs, government fiat failures, and seen Argentina reaching inflation 100% year over year. Can you elaborate more on your background and how did that motivate and influence you to launch Mountain Protocol?
Awesome. So caveat, the inflation last 3 months in Argentina is at 200% plus annualized. So if you look at the chart of inflation, we are hitting the highest inflation since the last hyperinflation in 1989. It's insane. So I'll send you the link. I think it would be good to put in the show notes.
Okay.
Anyone looking to explore time value of money, hop on a plane to Argentina. Yeah, it's the Roman Coliseum of centralized exchanges and kind of time value of money, and you can see all of that, and it's a great place for innovation. But my background, born in Argentina, kind of like I was a kid during the Corralito in 2001, but kind of like always been around financial restriction, right? Argentina, not the best run economy, lots of limitations. My first salary, the peso inflation at that time was low, 40% only. So I purchased Bitcoin with my friends because it was the easiest way to access a token that at least didn't go down in value at 40%. Bitcoin was up and down, right, as it usually is, but it was way more stable than the peso. And that kind of was my introduction to crypto. Before Coinbase started, I actually was part of the Mt. Gox receivership, so still waiting for my Bitcoin there. And since then, I've been involved in the space. My family still lives in Argentina, so very connected to how do you actually access good financial products. And crypto has been an amazing place to do that. My career, I went into traditional banking, risk, launching new products. I participated in launching 2 high-yield checking accounts. So to me, that's an obvious product, right? Like if the risk-free rate of a government is X, why wouldn't you get X if you're taking the risk of that asset anyways? So they were one of those was Goldman Sachs, Marcus, and then there was a second one. And I told about that to anyone, right? Like crypto's too risky, at least open an account like this if you can, right? If you're in the US. And then when Luna happened, I was like, okay, time for the third high yield checking account, right? Rates in crypto went to 0. Rates in the US started increasing. I was like, okay, now we can build a high yield checking account for the world. And the best way to do that is crypto rails because you can serve anyone can integrate you very, very easily. And that led us to building Mountain Protocol. And I think we're going to talk about it a bit more in the episode.
Well, one more thing I wanted to touch on, a lot of times, even in this podcast, a lot of times when I give talks, I'll use my mom as an example and I'll say, it's so easy, even my mom can use it. Love you, mom. You're great. But I love using, mom, grandma. I've heard you say your mom uses stable coins. And I just thought that was great. Could you talk a little bit more about that? What what motivates your family to, actually use this on a regular basis?
Totally. So if you think about a country where purchasing US dollars is not allowed unless you have a permission from the government, which is very hard to get, as you would imagine, the rate today is like 1,000 pesos per dollar in the blue market, which is like what actually trades. The official rate is like at 350. So it's like almost a 3-to-1. So whoever has access has free money because you can arbitrage at a 3x. So no one gets it. Now, my mom has two options. She can either go to a shady, like we call it cave, right? Like to a shop, you have to count the dollars. Maybe those are fake. You can get robbed when you get out of there and so on. Or she can go on her phone, send some pesos through a local payment network and receive stablecoins. She can then host those stablecoins herself, protect them, and then she has dollars, right? And then she can send them to me or she can do whatever. We actually did, my grandma is already now starting to buy stablecoins. I convinced her because the crypto market now is so efficient that the spread is lower than the cave market, which is the biggest. So I told her, you're saving X amount of dollars on your purchase and you get like this amount of dollars extra. And like, she's Italian, right? So like, that like, okay, I'm going to save $5. It makes sense. So she bought on crypto too. So it is the utility and the efficiency that we always talk about that brings people more into crypto. And then our hope is that Mountain Protocol will even increase that, right? Because we become a better dollar than a dollar that you have like on self-custody on paper on your home.
Yeah, I think so often, especially in the US or in the West, like we don't have those problems. And so we don't see exactly the solution that stablecoins or crypto can provide. And so, thanks for sharing those real world use cases with us.
Yeah, it sounds like you have your whole family getting into the stablecoin trade. Which stablecoin? Are they early users of USDM or are they using competitors? What's going on?
Yeah, so my family in particular, yes, but it's forced on them, of course, by me. We still are only on Ethereum. That is like Ethereum gas fees have spiked. It is not reasonable for an individual to trade on Ethereum, right? Like it's too expensive. I think that's the objective of Ethereum is going to be more enterprise and a settlement layer. We're launching L2s so that my mom can like actually be in Ethereum because it's worth it. But if you look at the average person in Argentina, in most emerging markets that I've been to, they use USDT on Tron. And the reason is USDT has a lot of network effects. It's accepted super widely. And the Tron reason is Tron was the first network to understand decentralization is important, but price is even more important. Today it's not the cheapest, but now it has the network effects. And many L2s are trying to go in and kind of break those. But yeah, Tron is still king.
Right. Yeah, the efficiency has to be there, or like the utility has to be there. There's a grand vision that brought everyone here, but it still has to compete and improve on what's already come before it outside of some of those initial ideas. So great to hear. And forced USDM use within the family. I think I should get my mom into the trading secondary insurance exposure.
Exactly.
What's going on.
Yeah. And what I would say, right, like in crypto circles, we discuss a lot about the risks of USDT and the risks of Tron and decentralization and so on. But what we don't put in perspective is you compare those with the risk of the Argentinian banking system, right? So if you say, I'll have $1 in the Argentinian banking system, whose dollars are in reserve in the Argentinian central bank, which is technically broke, or I can have USDT on Tron, it's still 10x better, right? So when you put those things into perspective, you understand why folks are moving out of whatever they're into USDT and Tron. So it's not, there may be better risk assumptions in many other products. We try to, of course, increase the safety of our products ourselves. But the status quo for most people, even when they move into those products, there's a 10x improvement in guarantees.
Very cool. Well, yeah, Martin, it's great to have you here. Quick lightning round for you. So just some very quick fire questions for our audience to get a sense of where you may be. So rate your knowledge in crypto from 1 to 10 and a very brief elaboration.
I would say stable coins probably an 8 or 9 out of 10. crypto in general, and DeFi in particular, and then the cryptographic, right, infrastructure, I would say F34, right? Like my background is very strong TradFi. I'm not a massive crypto person, right? Like I'm still learning a lot of that, and I enjoy it.
Sure. Well, the space is always lucky to have, deep TradFi expertise. So that's great to hear. Rate your knowledge in insurance, 1 to 10. That's our ilk.
2.
Two. Okay.
FDIC, that's as far as I go.
Very cool. Well, yeah, more to come in the mountain names saga. How many jurisdictions did you consider before landing in Bermuda?
Consider at least 10. Engage legal counsel, 5, where we spend at least $1 on legal counsel looking at those, and then kind of deep legal analysis too. So we spend a lot of time.
We're like speed dating countries, basically. Yeah,
exactly. And it's always changing. I think if you were to do it again, you would probably change.
I think there's a whole new conversation about how that speed dating went, and what's going on in the general space. There seems to be a really cool progress on the major onshore jurisdictions as well. So there's some real interesting dynamics going on. Favorite thing about being being a CEO, running a startup?
I think there's a speed, right? Like you can move and build the organization to move fast. I think regulated financial businesses tend to justify moving slow because of risk considerations. And I think like being a CEO, you can actually place the trade-off and think, okay, what's at risk here? And sometimes we move slower than we should in the regulated financial space. And pushing that is what I like.
Very cool. And final one, least favorite thing?
I don't sleep. I wake up at 5. I work till like 12.
Got you. Yeah, there lots of philosophy around how much sleep you should be getting. There's some villainization and idealization around that. So yeah, try and get some good sleep. But cool, thank you.
Yep. All right. Well, yield generation in crypto, I feel like that is the name of the game. We've had staking, we've had kind of fakey rewards, and now we're really pushing towards more of this tokenization of real world assets. On the missing link, we love to talk about that. We think, that's what we're doing at Names. And obviously USDM, by creating a yield bearing stablecoin, has made, some revolutionary moves in this space. But what I wanted to ask you about was how else does USDM differentiate itself from the rest of the stablecoins? I thought we could go a little bit deeper, not just the yield. What else is making it, more secure, better?
Yeah, I would say outside of the yield, the other part is we built the stablecoin in 2023, right? 2022, 2023. What that means is regulation is now a must, right? Like you cannot launch a stablecoin. To me, stablecoins are a tokenized bank deposit. That's how they should be regulated. And Bermuda, of course, offers that regulation and those guarantees. I feel the market still is a little bit behind in understanding the regulation versus regulation exception versus the levels of regulation that you can have. But that's a big one. And there's a lot of guarantees that come around being regulated. The second one where we differentiate ourselves pretty bigly is on our management of the reserves. Specifically, we don't have any bank deposits, right? Or we keep nominal bank deposits. And the reason is March 2023, this year, there was a bank run on SVB, and the second largest stablecoin, there were questions whether it was solvent. The biggest question around that was holding a larger balance of deposits in banks, and banks, in the end, is a licensed unsecured hedge fund, right? Like they invest in mortgages, in car loans, in credit cards, but essentially you're lending money against unsecured, against a portfolio of assets. And if that goes down, good luck. The issue with banking is it's the riskiest part of the chain. And there's an adverse selection where the banks that you work with tend to be the banks that need you the most. And those are the ones that have the highest likelihood of having a problem. So being very cognizant of the portfolio of whatever real world asset you're working with, what is their bank exposure and which banks they are. And you can easily go into like their banks, go into Fitch, get the rating. If it's not AAA, AA, yeah, probably some questions to be answered.
So what do you do instead?
So the question is, that's a stable coin, right? People want to get in and out very quickly. So if you don't have bank deposits, you have to have another arrangement in order to provide that liquidity. What we did is an arrangement with a large OTC, Wintermute in this case, which did a risk assessment on Mountain Protocol, and they said, we'll take USDM one-to-one. We'll give you that USDC whenever you need it. So they take it out of whatever markets they're making. They send it to us. That can happen on a Saturday, right? So now you have redemptions on Saturdays, which you cannot do with bank deposits. And essentially, when the market opens on Monday morning, we sell the T-bills on ramp and then repurchase that USDM from Wintermute. So essentially, they act as a buffer between the customer redemption request and the T-bill kind of TradFi timeline, which might take T+2. They're holding the asset in the USDM during that period of time. And that allows you to have a very large redemption guarantee, because you're talking about a very big balance sheet in terms of Wintermute without any exposure to bank deposits.
Wow. And am I right? Also, you segregate customer deposits in a unique way.
That is how the BMA requires it, right? So whenever you're holding customer deposits, whether you're on exchange, whether you're a stablecoin issuer, you are required for those assets to not be segregated from company estates. So in the case of liquidation, let's say we go under for whatever reason, the USDM depositor shouldn't be waiting for 10 years for the bankruptcy procedure to finish and get their deposits back. Company estate, yes, there will be that procedure. USDM deposits. So USDM holders, T-bills are liquidated, cash gets concentrated and then distributed to USDM holders pretty quickly. And I think that is how brokers work. That is how custodians work. It is natural that stablecoin should work the same way.
Yeah.
And so just for our listeners,
not all stablecoins have that.
Yeah. Shout out. How are you licensed? You mentioned the BMA, the Bermuda Monetary Authority. You talked about tokenized bank deposits. What does that look like? What clarity did you guys get in 2022, 2023 as you were looking at it?
So the specific license we got is issuing of digital assets for the purpose of USDM. So there is no banking description in our license. The other license we got is custodial wallet services, so we can custody your USDM when you're using the platform, but that's kind of like a side effect of us running our main business. But if you look at the content of the regulation, the main thing that gets looked at, of course, AML, right? So you have to be compliant. Everyone, I think, will go in that direction, and cyber. But the main one is prudential. And if you look at the spirit of those regulations, they look exactly like a bank, right? The only thing that they don't have is on the credit side. You don't have credit modeling and so on, because we don't extend credit. Well, we extend only to the US government in very short term. So like a very, very easy to assess credit risk profile. But outside of that, the prudential regulation looks exactly the same.
Yeah, I imagine, there's definitely been a wave of excitement around this sort of model, just the general kind of yield-bearing stable coins. How do you see the landscape at the moment? It must be changing quite quickly, and you're at the front of that. How are you guys as a business approaching that?
Yeah, so I think there's four models of stable coins, right? Stable coins will accrue value. The question is to whom, right? So on one end of the spectrum, you have a CBDC, right? A CBDC will probably not pay any yield. So the yield is kept by the government, right? So in whatever government issues, the central bank will essentially keep that yield. You have the Circle or Tether model, where the issuer keeps the yield, and then the issuer will spend that yield on marketing, and they will kick back like USDC on Coinbase, and there will be some arrangements, but in general, the issuer keeps all the yield. You have the model of the broker, right? So verified USD, USDV, launched recently, and their model is will pay the broker or the person influencing your purchase to incentivize using the stablecoin. So instead of having the bank, the central bank or the issuer, they are paying it to the broker. In this case, a Wintermute. If they sell USDV, they're going to make the yield on that USDV's lifetime. And then the last, Paxos also falls very much here, right? Like the model with Binance USD is paying Binance to put their stamp. They're working with PayPal, right? So paying the broker. And then the final model is paying the holder, right? We think the holder is going to win because in the end, you have to have a reason to hold the asset. Right. And there's a couple. SDAI, I think, is the other big one that's paying the holder. They are by far the largest coin out there. Our way of competing is we want to provide the lowest risk token out there that pays you something around the risk-free rate. So it's low minimum counterparty risk, minimum regulatory risk. So minimizing all those risks, and that's the market we're going after. And I think there's space for others, like SDAI targets decentralization, right? So if you worry about decentralization, SDAI is probably the path that you're going to go. I think there's space for many holder-focused yield-bearing stablecoins.
SDAI is single collateral DAI from Maker. Is that what you're referring to, or is it?
It's savings DAI. So you stake on with DAI, and essentially there's the governance decided to funnel revenue, which most of that is coming from T-bills today.
The DAI savings rate.
Exactly, the DSR into the SDAI.
But this is the Maker DAO, Maker Foundation project.
Exactly.
Got you. And another area that does fascinate me, and it sort of links into the landscape that you've just painted there, is how do you guys as a company consider your go-to-market? You spoke a lot about the Argentinian story there. There's a real demand, and it's going all the way up to the grandmothers of the world. That's the kind of perfect scenario that you'd want, is that people are completely chomping at the opportunity to be able to use something like that. Maybe less so in other jurisdictions. Do you think of go-to-market in terms of jurisdictions, in terms of different economies, or is there another way to think about this?
We think about it in terms of use cases and the use cases we can fit best at different stages of the company, right? I think today we just launched. We're going to be around 12 million in TVL at the end of the day today with a new minting. That means we're a new stablecoin, right? Whoever is jumping in is either a crypto degen, I would say, so someone who's used to taking risk on new assets, or it's a very sophisticated player that can understand the risk. For 99% of the population, they look at the TVL, and that's enough to cross and not continue exploring our stablecoin. So right now we're very focused on those two personas. The sophisticated player today, they usually have already gone into U.S. Treasuries. So we have to go into who has not got into U.S. Treasuries with our differentiation, which is permissionless. In particular, exchanges is the biggest one, because exchanges, they have a custody setup that requires the asset to be an ERC20, that they can move freely, that they don't have to be signing a bunch of transactions, whitelisting a bunch of addresses. So exchanges is where we're getting the most traction today. Soon, I think there's going to be DeFi integrations that we're working on that will bring some degens in. So I think that's who we're going after immediately right now. Our best case go-to-market for the second phase, which is you're starting to build up. TVL is no longer an issue. I think above 100 million, TVL is no longer a concern. You're talking about more conservative organizations that understand the risk. They look at the TVL, it checks, and they can start getting in. It's protocols, it's names, it's GMX, so that you can leave USDM as collateral for opening a derivatives position. It's Aave. So it's a lot of more institutional finance use cases. And I think you start getting into retail. And then I think the third, probably after a couple billion, it's like my mom holding it, right? Someone like my mom, no, but my mom's friends, right? Who don't know.
That's a big ask if you want to take it up from 2 to 10 billion. Your mom's going to have to really double
Exactly.
down.
She has to get a lot of friends. But I think retail is a very strong, Tether growing through the bear market is an example of the power of retail. And the second is more traditional companies. We have lots of outreaches from payment companies like companies that have working capital sitting there, and they're like, that working capital is working for the bank instead of working for me, and they want to move in. Those will require a lot more before they get in. They require us to be rated. They require us to be bigger. There's a bunch of integration. They want to see more time, years of history without any regulatory problems. But that's the big money. That's how you go from 5 billion to 100 billion. Right? Like that's where the big money is.
Yeah.
Well, and that resonates with me. Like my kind of, I guess, probably would fit more in that degen category, but like my friends, my people my age that got into crypto early, none of those like traditional finance things really interested me. I was like, I'm not going to do a 401k. I'm going to buy ETH. I'm not going to do this. And so this is a cool way to bridge that gap where, I don't have any way to participate and, earn that rate. But now I can kind of still keep my feet in crypto and still keep that kind of degen aspect of it, but then still earn some of that yield. I think that's, brilliant.
Yeah. Then there is a real retail story, and it's a major win for this kind of technology, of saying that because of the rebasing mechanism that you have and the composability that digital assets allow, is that you could imagine, retail users holding capital that they're going to use on their groceries, and having exposure before they buy the groceries to the market rate, and that's not the case at the moment. You very much have to segment your capital in the traditional space into, you've got a small amount of liquid capital in a current account, and then you've got savings and wherever else, above that, if you're lucky, investments, equities, but it goes on. And here there's a potential, or perhaps it's already the case, is just ready to scale, where you can actually kind of bring that back to current account type liquidity, where you're able to go out and spend and live your life, and you have these kinds of exposures because you're able to track where those dollars are, and who's going to generate the return. Is that a right way of thinking about that kind of 2 to 10 to 20, 25 billion?
That's the right way. And I think that the mental model is, if you look at high yield checking accounts, you can now earn the yield until you spend the money, right?
Yeah.
So. Right. High yield checking accounts showed that retail wants these products, right? Mm-hmm. But high yield checking accounts are only available in the US, and offshore they're only available to like very large companies, right?
They're not available to me. My bank gives me like 1 cent. It's like, thank you for that.
You should go to Rate Compare.
It's like laughing at you.
Yeah,
it's laughing at me. It's insulting.
Yeah. And there are those. I think if you're in the US, going to a high yield checking account, FDIC insured for your first 250K is probably a no-brainer. If you have your money not paying you 5% in a bank, you're probably leaving a lot of money on the table. And when you do the math, you're like, this is like, I don't know, a couple of gifts for Christmas that you could be paying every year. And this exists, right? If you go to Argentina, for example, Argentina is an amazing case study because the time value of money is so big, right? Like in 3 days, you get 1%. Right, so like over a weekend, you get 100 bits of yield. Wow. So like everything, like there's a lot of innovation. The Venmo of Argentina pays you 100% on your pesos today, right? And that is becoming the wallet that people use on their day-to-day basis. How I think we can fit there is, you could keep your savings in dollars, collateralize a card, and start spending in pesos. And then whenever you get paid your salary, you just send your salary to pay that credit card. And essentially you continue saving in dollars. You never have to spend them. You just use them as collateral for your card. And that way you can underwrite an individual without any credit score. So I think there's a lot of retail use cases. And then of course the enterprise use cases, right? Like the names, the collateral of names should be paying 5%, right? It's ridiculous that it's not. If you are doing an import and you're sending money to an escrow, that escrow should be earning 5%. If you are in an LP position, and if you think about the future of Forex, if it's going to be in DeFi, there's going to be a Uniswap pool that trades USD to Euro. Both those ends should be earning the risk-free rate of those assets. So USDM should be there earning whatever the Fed is paying, and Euro should be earning theirs. And then the fee should be making on top so that professional investors can participate there and earn above the risk-free rate. So I think every dollar out there and every essentially fiat asset should be earning the risk-free rate. And we're doing our job for the dollar, and there's other teams doing their job for other assets out there.
You identified, 4 areas of stable coins. That area of, the largest stable coins right now where they're earning the rate, do you think that they will move more to this model where they will pass on the yield to their users?
Following the stablecoins are banks. And in my experience in banks, this discussion comes often, and banks still pay 0%. And if you look at the US, Bank of America, JP Morgan, Wells Fargo, they pay you 10 bips or like nominally 0. Why can they do that? Because people still stay. Right? And the math, they're not going to move and destroy their revenue from 100% to less than 10% unless they have like an existential threat.
If they get really threatened by you, that's what I was thinking.
Exactly. But those finance is slower than most people think.
Right.
And I think the best example of that is Maker Savings DAI. The risk assumptions that you're making from going from DAI to Savings DAI is the exact same. You don't have any additional risk. But the utilization of Savings DAI is less than 25% of the whole DAI issuance. So you're talking, there's like literally like very easily addressable 0 additional risk, and you're getting 5%.
And that's what the demographic of very forward-thinking, users, right? Not
Correct.
your, traditional don't want to know, stick my head in the sand, finance nut. So that's a good point. Actually, it's like the space that is literally by definition experimenting with new financial opportunities and tools. That there's still that discrepancy between DAI and SDAI. Or the DAI savings rate. So
if you think about the general economy, that number is 10 of 25 is going to be 5%, 2%. I don't know. It's like minimal.
Makes sense.
Yeah.
Do you have any? So I feel like we've talked pretty large scale. If you had to kind of zoom in on just 2024, do you have any predictions for the stablecoin, landscape, or maybe what does it look like? How does it change if there is a bull market next year?
Yeah, come on, Daniel.
Yeah, that's a good question.
I'm still saying if. Sorry, if there's a bull market.
Yeah, if when it's hard to predict, right? Because these things, lindiness is very hard to predict when lindiness starts to kick in, and these things start to transform. There's a bunch of projects on stealth, kind of like launching out. I think. What I can strongly predict is the model 2, where the issuer keeps all the money. I think that model will continue to shrink, and then model 3 and model 4 around like keeping it on the broker. I think the broker has a lot of power, which it is easy to underestimate. But like PayPal USD, they're growing a lot, and like they're paying brokers a lot of money to get PayPal USD out there. I think USDV also has a lot of potential, and then paying the holder. I think this is where the growth is going to happen, right? Hopefully, Tether continues to grow because they have their network effects already there. So it's like the CAGR of whatever retail and kind of natural adoption of stablecoins. I think as these things start to become more robust, part of that growth will transition into models 3 and 4. So I think you'll see a lot more of the latter models.
So it sounds like you don't see them necessarily as, competitors in a way, but it's, if everyone succeeds, it's good for all the stablecoins.
So stablecoins today is 120 billion market, pretty small. It was almost like, I think 160 or 170 prior to Luna exploding. The US dollar size is 20 trillion. So you're still talking about peanuts, right? In the end, the way to win is expanding how many dollars get into crypto. That is the biggest win here. It's not competing between one coin and the other. It's like, how do you build new use cases that convince people to, instead of going through the Swift, through ACH, through paper money, whatever that is, moving into crypto dollars. That's where the growth is.
Yeah, and also I feel like it's not a single company that in different sectors that's driving regulatory clarity and regulatory progress. It's use cases that come with lots of companies behind them. So yeah, the more stable coins in your example that come through these different pieces, the more clarity on the regulatory side there's going to be, the more adoption there's going to be, and I feel like there's been a decent amount of work that's been, that's happened with stablecoins over the last, 8+ years. And then particularly with this kind of model, you guys are in a great position. I feel like, in the venture space, which has gone through a sort of tightening, there's still been, really great flow into your use cases. And as that kind of eases, you're going to be very well positioned from a competitive standpoint as well. But yeah, absolutely, the more the merrier, really. And the space has a general, obviously it uses a competitive tension for good effect, but there's a great kind of openness to learning that projects are able to integrate into their own solutions. So yeah, very, very excited for you guys. Love the TVL milestone as well. Congratulations on that front. We're very excited to be watching from the sidelines on how you guys continue to grow and see the use case within names and in other places continue to grow. Final question, I guess from us. The missing link. You actually touched on a few throughout the talk that I thought would fit well into this question. I'll maybe comment on that afterwards. But for now, what do you see as a key missing link in this digital asset, general space that is still left to tick off before that kind of, $1 trillion to $20 trillion gap is filled?
Yeah. So if you think about the fundamentals of some of the products that are existing in crypto today, they are 10x better than the products on TradFi, right? And the argument is anyone who starts operating on crypto, a vendor sends them a fiat payment and they're like, yeah. So like once you go, yep. it's hard to go back to fiat. And the question is, why are not more people moving into crypto? So what is stopping them? I think there's a couple things. Regulation is still something that most people in crypto are against. And I think for some models, regulation stops innovation. But for other models, especially models where there's a natural tension between the company to take more risk and the user not being able to enforce the company to not take that risk, traditionally banks or insurance companies, or in general, anyone holding assets on behalf of customers, regulation is still kind of a new thing, right? Like how many regulated crypto companies are out there? I think if it's 50, it's too many, right? Like it's probably less than that operating. So we need to get regulation that people know how to assess, right? And there's a lot of like fake regulation advertisement and so on. So like the regulation clarity, I think, is coming, but also how do you separate from good regulation versus kind of like, I am regulated, but you're actually not. So I think that's a big one. And then kind of like making that regulation more widespread, especially in the US, right? In the US, it's very, very hard to be operating, and most companies in the world, large capital allocators, are in the US. So they have a portion of their operations in the US, so they don't want to be touching these assets, and that creates a lot of, okay, if this company is not doing, why is it, right? Like they must have a reason, and that is stopping a lot of other companies elsewhere from moving in. And I would say the last one is service providers, right? Audit firms are getting stopped from working on crypto. Banks are getting stopped from working on crypto. So a bunch of the high quality service providers are being blocked for reputational reasons. Mainly, we still haven't come to the conclusion that compliance is very good in crypto. So that's a big flag that's been getting used against the space. So if we can get those parties and say a KPMG to come in and say, yes, this audit is accurate, and you can have like that level of stamps in, that will help us better. Moody's, right? Like credit ratings would be another strong one. So I would say regulation across the main jurisdictions. So not only Bermuda, Singapore, the UK, but also the US, and then kind of like the high quality service providers to jump into the space.
Wonderful.
Yep.
Yeah, feels like we're the missing links, plural, still, but no, very, very interesting. And one thing that struck me, I guess, about the conversation was that sometimes I feel a sentiment where DeFi summer, retail investors came in and interacted. There was a great boom. What's the next stage from going to 100 billion to a trillion in DeFi? Or it's institutional. It's institutional. Whereas hopefully that continues to grow and be the case, but it feels like there's a real opportunity to open up to a proper retail market as well. It's not like, okay, retail's come in, that was fun, now on to institutions and all the regulatory pieces that are needed around that. There is still very much a retail opportunity here, which goes way, way, way beyond what we've seen. So very eye-opening for me, Martin. Thank you.
And I think when you think about retail, I think there's retail like my mom, and there's also retail almost like an SME. And SMEs are a big player that has not participated in crypto thus far. We're seeing some companies start to pop up and say, we'll build the best bank for an SME of like 100 people in Argentina. And we'll connect to a local payment network, but you also have $1, a euro, a Brazilian real, a stablecoin account. You don't see it's a stablecoin, like you just see the dollar. If you go to terms and conditions, you'll find it, but they're making it very easy for the user. It's crypto on the back, it's fintech on the front. People are used to it. So I think that is going to be, that for retail and for SMEs is going to be a massive kind of TVL bringer.
Very cool, yeah.
Thank you, Martin, so much for, go ahead, Dan.
No, it's just it's great to hear other players obviously pushing in their different verticals as well, because we see the rating agency piece in the insurance landscape, insurance specific. We see the SMEs coming in that have nothing to do with crypto, that see the benefit from an insurance perspective using this, and obviously that happens across lots of other verticals. So yeah, thank you for all the work that you guys are doing.
So much still to learn and so much still for us to do and work together. Last thing I just want to say, Martin, if people want to find you or learn more about Mountain Protocol, where should they go?
Yeah, for Mountain Protocol, X is the best source of information. At Mountain USDM is the address, mountainprotocol.com. For myself, at Carrica on Twitter. I also write on Substack. I want to write this article around like the 4 issuers and how you think about those. So if you subscribe, you'll receive that whenever it comes out.
I will. All right. Thank you.
Awesome. Take care,
Thanks
guys.
so much, man.
Bye-bye. Thank you.
Bye.
We're one step closer to finding the missing link. If you enjoy our show, please rate and review us wherever you get your podcast. And be sure to come back next month. Until then, we are the missing link.